Today we're going to look at the company Crown Crafts, headquartered in the United States and traded on the NASDAQ under the ticker CRWS. Please stay tuned for the important disclosure information at the conclusion of this video. Crown Crafts has undergone a remarkable transformation from a small regional textile manufacturer into one of the nation's leading distributors of infant and toddler products. Founded in 1957 by Irving Ostu in northern Georgia, the company was originally known as Janiho Inc. and focused on producing adult bedspreads. As the business expanded into more intricate jacquard woven textiles, it officially adopted the name Crown Crafts in 1968. The same year, it began trading publicly on the American Stock Exchange. The company spent several decades as a dominant force in the adult bedding market, even listing on the New York Stock Exchange in 1994. However, a strategic shift began in 1995 when management recognized significant growth potential in the infant and juvenile segments. This pivot became permanent in 2001 when Crown Crafts sold its entire adult bedding division to a management team to focus exclusively on products for the crib and beyond. Shortly after this transition, the company relocated its headquarters to Gonzales, Louisiana, in 2002 and reincorporated in Delaware in 2003. In recent years, Crown Crafts has aggressively expanded its portfolio through major acquisitions. In 2017, it acquired Sassy Baby, followed by the Manhattan Toy Company in 2023. Most recently, in July 2024, the company acquired Baby Boom Consumer Products, further strengthening its hold on the toddler bedding and diaper bag markets. Crown Crafts operates as a leading designer and distributor in the infant, toddler, and juvenile consumer products industry, utilizing a capital-efficient business model that prioritizes brand management over internal manufacturing. The company is organized into two primary wholly owned subsidiaries, Nojo Baby and Kids and Sassy Baby. Through these divisions, Crown Crafts offers a comprehensive range of products including infant and toddler bedding, diaper bags, bibs, and developmental toys. By outsourcing nearly all of its production to high-quality third-party manufacturers, primarily located in China, but increasingly diversifying into regions like Cambodia, Pakistan, and India, the company maintains flexibility to adapt to shifting market trends and consumer preferences. The company's customer base is exceptionally diverse, spanning nearly every major retail channel. Its primary market remains the United States, where it serves mass merchants like Walmart and Target, as well as mid-tier retailers, juvenile specialty stores, and wholesale clubs. However, Crown Crafts has significantly expanded its international footprint. It now maintains over 30 international distributors operating in more than 50 countries, and recently launched a new licensing initiative for Disney products in Canada as of January 2026. This omni-channel approach is further supported by a growing direct-to-consumer presence through its own brand websites, ensuring a direct connection with modern parents worldwide. The journey of Crown Crafts over the last 20 years is a testament to the resilience of the juvenile products sector, despite the pressures of a changing retail landscape. In the mid-2000s, the company was heavily anchored in traditional infant bedding, which often accounted for the vast majority of its top-line revenue. This period saw the company leveraging major licenses to maintain its position in big-box retailers. As the decade progressed into the 2010s, Crown Crafts reached significant revenue milestones, notably in 2011 when net sales touched approximately $90 million, driven by a banner year for its core infant products. As the retail environment shifted toward e-commerce and specialized boutiques, Crown Crafts adapted by diversifying its product mix. While bedding remained a cornerstone, there was a visible pivot toward higher-frequency purchase items like bibs, burp cloths, and disposable products. This diversification was further accelerated by strategic acquisitions. For instance, the recent acquisition of Baby Boom helped stabilize revenue in 2025 during a period where inflationary pressures caused many consumers to scale back on discretionary spending. The financial data reveals a company that has managed to maintain a relatively consistent revenue range between $65 million and $90 million for nearly 2 decades. The dips seen around 2017 and 2023 reflect broader macroeconomic trends, including the restructuring of major retail partners and the post-pandemic normalization of consumer demand. Throughout these cycles, Crown Craft has focused on maintaining a strong balance sheet and a commitment to shareholder value, frequently declaring dividends even during transitional years. By evolving from a traditional textile company into a diversified infant products marketer, Crown Crafts has successfully navigated 20 years of market evolution while remaining a leader in its category. The 20-year financial trajectory of Crown Crafts represents a case study in operational durability within a mature consumer niche. Based in Gonzales, Louisiana, the company has operated as a leading designer and marketer of infant, toddler, and juvenile products for over half a century. When we walk through the waterfall from total revenue down to the final free cash flow less stock-based compensation figure, a pattern of cash flow harvesting emerges. Crown Crafts has consistently maintained an asset-light model, sourcing products from Asian manufacturing partners rather than operating its own factories. This strategy keeps capital expenditures exceptionally low, typically under $1 million annually, allowing almost every dollar of cash from operations to be converted into free cash flow. The journey starts at the top line, where revenue has remarkably stayed within a band of $65 million to $90 million for nearly 2 decades. This stability is driven by the non-discretionary nature of infant products. Parents continue to buy bibs, blankets, and bedding regardless of the broader economic cycle. However, the cost of goods sold remains the largest hurdle to cash generation, typically consuming 75% of revenue. Margins are sensitive to geopolitical shifts, such as the increased U.S. tariffs on Chinese imports that pressure the company's gross margin in fiscal 2025. Operating expenses, including sales, marketing, general, and administrative, represent the overhead required to maintain brand presence and manage licensing agreements with global giants like Disney. The 2025 fiscal year was a notable outlier in this row, as the company incurred $1.2 million in costs associated with the acquisition of Baby Boom Consumer Products, which brought popular licenses like Bluey and Miss Rachel into the fold. Despite these temporary spikes in administrative costs, the core cash-generating engine remained intact. The transition to operating cash flow is where the company's balance sheet discipline is most evident. Crown Crafts manages a tight cycle of working capital, balancing payables to suppliers with collections from mass-market retailers like Walmart and Amazon. In fiscal 2025, the company reported a GAAP net loss of $9.4 million, but this was a non-cash accounting loss driven by a $13.8 million goodwill impairment charge. When reconciled, the actual cash generated from operations was a robust $9.8 million, a significant year-over-year increase. The final metric, free cash flow minus stock-based compensation, represents the purely liquid surplus available for shareholder rewards. Because Crown Crafts requires very little cash to keep the lights on, the conversion from operating cash to free cash is nearly 1-to-1. By removing the non-cash stock-based compensation, you arrive at the pure owner's earnings that have fueled the company's long-standing quarterly dividend. Over 20 years, this figure has remained positive, surviving the 2008 financial crisis, the retail bankruptcy of Toys R Us, and a global pandemic, proving that fiscal discipline and a niche market focus create long-term durability. The financial history of Crown Crafts over the last 2 decades is a fascinating narrative of a company that transformed from a debt-laden turnaround story into a highly disciplined, dividend-paying cash machine, and eventually into a strategic acquirer of modern juvenile brands. To understand the current profile of the company, one must look back at the 2006 to 2010 period. During this era, Crown Crafts was heavily focused on cleaning up its balance sheet. In 2006, the company carried nearly $15 million in financial debt. For the first few years of this 20-year span, no dividends were paid, as every dollar of generated cash was directed toward retiring high-interest debt and strengthening the core business. By the 2011 fiscal year, the company had significantly stabilized its debt profile, marking the end of its survivalist phase and the beginning of its identity as a premier yield stock. From 2011 to 2022, Crown Crafts operated with a philosophy that prioritized immediate cash returns to shareholders above almost all else. The company became known in the microcap world for its lumpy dividend history, which was a direct result of its use of special or strategic one-time dividends. These significant payouts are clearly visible in the table. For instance, in fiscal years like 2013, 2017, and 2022, the total dividend payout far exceeded the free cash flow generated in those single years. This was not a sign of distress, but rather a deliberate choice to flush excess cash reserves to shareholders when management felt there were no immediate, high-value acquisition targets. This strategy resulted in an exceptionally high dividend yield, often exceeding 10%, which anchored the company's valuation for over a decade. The most recent three-year period, 2023 to 2025, represents a tectonic shift in the company's capital allocation strategy under new leadership. After years of organic stability, the company entered an acquisition supercycle. In fiscal 2024, Crown Crafts completed the $13 million acquisition of the Manhattan Toy Company, followed quickly in fiscal 2025 by the $13.9 million purchase of Baby Boom Consumer Products. These were transformative moves intended to diversify the company's portfolio into modern categories like toys and high-end diaper bags, reducing its reliance on traditional infant bedding. These acquisitions have fundamentally altered the balance sheet, bringing debt back into the equation. By the end of fiscal 2025, financial debt had risen to over $18 million. However, the company's underlying cash engine remains robust. In fiscal 2025, even with economic headwinds, the company generated $9 million in owner's earnings. This indicates that while the debt level has increased, the company has the capacity to retire these obligations, just as it did 2 decades ago. The current management has signaled a commitment to maintaining the regular quarterly dividend while focusing all remaining cash on integrating these new brands and deleveraging. Today, Crown Crafts is a business in transition, moving from a passive cash return model back into an active, growth-oriented enterprise that still respects its heritage of fiscal discipline. Crown Crafts is currently led by Olivia Elliott, who serves as the president and chief executive officer. Now 57 years old, Elliott is a seasoned veteran of the company, having first joined in November 2001 as treasurer. Over more than 2 decades, she ascended through various leadership roles, including a significant tenure as chief financial officer starting in 2008, before ultimately assuming the CEO position on March 1, 2022. In terms of her financial standing at the company, Elliott's compensation reflects a mix of guaranteed and performance-based rewards. For the 2025 fiscal year, her base salary was reported at $400,000. Her total compensation for the 2025 period reached approximately $900,000. The ownership structure of Crown Crafts is characterized by a significant level of insider commitment and institutional backing. As of early 2026, individual insiders hold a notable 19% stake in the company, with Elliott herself directly owning approximately 3% of the outstanding shares. Institutional investors maintain a slightly larger presence, controlling about 23% of the company. The remaining portion of the company is publicly owned, representing the float available to individual retail investors. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. In a bull case scenario, Crown Crafts successfully transitions from a traditional wholesaler to a digital-first powerhouse. This future is driven by the seamless integration of high-margin licensed products, which allows for significant cross-selling and premium pricing. By 2045, the company has mastered a direct-to-consumer model that bypasses traditional retail margin traps, allowing operating cash flow to surge as logistics are fully optimized. In this story, the company becomes an acquisition machine, steadily buying distressed boutique baby brands and scaling them through its established distribution network, all while rewarding long-term shareholders with aggressive dividend growth. The base case assumes a steady but more cautious path where the company maintains its current market share amidst moderate birth rate fluctuations. Catalysts here include successful cost resets and the completion of its IT and warehouse consolidation, which helps restore gross margins to historical levels. In this scenario, revenue grows at a pace slightly below inflation, supported by periodic bolt-on acquisitions funded primarily through internal cash flow. The company remains a reliable dividend play, maintaining its payout streak while using share repurchases as a secondary tool to provide value during market downturns. Conversely, the bear case envisions a future where persistent macro headwinds, such as high tariffs on Chinese imported materials and a declining birth rate, permanently erode the company's profitability. In this narrative, the baby boom and Manhattan toy acquisitions failed to provide the expected synergies, leading to further non-cash goodwill impairment charges like the $14 million seen in 2025. Operational cash flow remains thin, forcing the company to eventually cut its long-standing dividend to service debt or maintain basic operations. Under this pressure, capital expenditures are slashed to the bare minimum, and growth stagnates as the company struggles to compete with larger, more diversified consumer goods conglomerates. In the bull case scenario, we assume the following: revenue growth at 4%, operating cash flow margin at 12%, capex growth at 5%, stock-based comp growth at 4%, dividends growth at 5%, stock repurchase at 0%, acquisition spending in the next 20 years at $175 million. Stock repurchases assumes price-to-sales ratio of 0.5. With this discounted at 7.5%, dividend model yields $5 worth of value per share in 20 years, $7 in 30 years, and $8 in 40 years. In the base case scenario, we assume the following: revenue growth at 1.5%, operating cash flow margin at 9%, capex growth at 3%, stock-based comp growth at 2%, dividends growth at 1.5%, stock repurchase growth at 0%, acquisition spending in the next 20 years at $70 million. Stock repurchases assumes price-to-sales ratio of 0.5. With this discounted at 7.5%, dividend model yields $4 worth of value per share in 20 years, $4 in 30 years, and $5 in 40 years. In the bear case scenario, we assume the following: revenue growth at 0%, operating cash flow margin at 4%, capex growth at 1%, stock-based comp growth at 1%, dividends growth at -1%, stock repurchase growth at 0%, acquisition spending in the next 20 years at $10 million. Stock repurchases assumes price-to-sales ratio of 0.5. With this discounted at 7.5%, dividend model yields $1 worth of value per share in 20 years, $2 in 30 years, and $2 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.